Today I will cover Industrial Logistics Properties Trust, short ELPT. Now this is a REIT active in the United States of America, and they mainly have logistics properties on the market, so renting out those. Why should you care? Well, it's a great opportunity to potentially make some money for you as an investor. If you have a high risk tolerance, in this case due to this being an extremely small cap company with a lot of things going on. To find out what's going on, continue watching this video and I will share with you some analysis. Starting with the basics of this business. Now you can see the total of industrial and logistics properties here, and we can see that an very high degree of those are leased out, 99%. This is extremely high coverage for leased properties and great to see, as well as remaining lease term of 9.2 years on average. This is very stable for a property and more typical of the logistics sector, whereas offices are more risky, the leases can be shorter, but in this case we see long leases and we also see some strong results on the income statement. But more on that later, because first we need to cover a timeline here on something very interesting that's been going on in the company. As you will see in the next slide, share price has absolutely tanked recently for this rate, and this is due to them cutting dividend. This happened in the past here to just a cent a share. And where have we seen this type of behavior from management before? Well, if you've subscribed to the channel and followed along, you've seen that Huang LNG did exactly the same to increase liquidity in the company. And indeed, this rate is trying to increase liquidity in the company to plan for this acquisition here of Monmouth. And this is the reason for the dividend cut thus. But even though they're doing investments, they're doing an acquisition, the forward-looking statement from the company has been that the dividend will return only to historical levels. So even though they're making an investment into the company to develop it, they still only anticipate that dividend will return to normal, and this is just awful, honestly. And as you can see on the share price, it has absolutely tanked on this type of news and continue to tank and tank and tank. Because if management is investing into projects, well, then we won't have greater returns in the future. And this has not been communicated clearly. This is a small cap company, less than $1 billion, planning and having taken on a lot of debt here in this case, as we've seen in the balance sheet. This is not something that investors want to see in a market where the rates are going up. And as you can see in this summary, debt to equity is just terrible. But starting from the top here, this is high risk, high reward, and from the income statement we can see that a lot of the losses that is showing that the price to earnings is not good, being negative, is non-cash flow affecting posts, so loss on impairment of real estate. I will show you the appendix for this at the end of the video, the actual income statement from the company. But just to finish off this part of the video, we can also see that if we divide the equity with debt and equity, we can see that less than 30% of the total assets on the balance sheet is actually equity, and the rest is financed with debt. So very leveraged, very risky, could potentially go bankrupt as a result of this if the macroeconomic environment turns worse. But risk, reward, there's a potential to make a ton of money for those who have diamond hands, and if company succeeds and thrives. I will do some analysis on digital media companies coming up once I get more knowledge about the industry. I don't want to do an analysis when I know just a little bit about the industry. That's when you have the most confidence and believe everything, just like all the AMC apes going into that business. But that's something you can look forward to. I'm gonna tab out here and just go over to the balance sheet real quickly before I end this video. So as you can see here, rental income in the top row here for the latest quarterly earnings report. And then we can see expenses, real estate taxes, this is something they actually pay out, this affects cash flow. Operating expenses, same. Depreciation and amortization. Amortization affects cash flow, you pay down, and general administrative as well. And then loss on impairment of real estate. This is a non-cash flow post, and this is also indeed what makes the results come out at a loss of $2.20 a share. So they're actually having positive cash flow. However, we can check the definition here. This is for the general accepted accounting principles, defined as the fair value of the asset being lower than what it is on the balance sheet, basically. So they're writing down the value since they believe it's not recoverable. This is a common accounting trick to not pay taxes, basically. So what's really going on in this company? I mean, there's so much potential, there is so much risk and uncertainty at the same time. Had this been a Swedish company, I would have known the locations of the properties, if the roads are good, I would be able to ask my network. But since this is in America, it's really hard to value and see if the risk to reward ratio is great. And for me, this means I will pass up on this opportunity. But if you know more about this company and you check out their website, you can see the types of properties they have, well, then you know if it's in great location, if they are strategically placed in the country. Maybe if you're a truck driver, you will have excellent knowledge in this area. So I hope I have a truck driver from the United States among my subscribers, because your expertise from your job will make you an excellent judge on the potential profitability of this company if their logistics properties are on some sort of main road that's being heavily utilized in America. You will have great knowledge from your day-to-day work to determine if this is a good investment or not, far greater than mine, because I just look at the financials in this case. We see balance sheet, I can show that one as well, it's a little bit further down here, how heavily in debt they are, total equity here and total liabilities. So you can see that it's super risky. That's what I can tell you. But remember, it's a business, and if you follow along in Peter Lynch's footsteps, then this is an excellent opportunity if you have local knowledge and you can use that knowledge to determine that, well, the reward here is far outweighing the risk, and this is an excellent opportunity for you. In my case, I will let this pitch pass me by and then swing at another one where I have more local knowledge. Alright, that's been it for this video. Time to wrap it up, and as always, hope you make a ton of money whatever investments you decide to make. Take care now. Bye bye.